Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Matt Bartolini, Head of Spider Americas Research at State Street Global Advisors. We're talking about the market outlook and investing strategies for 2024. Matt, welcome back. Great to have you on the show.
Yeah, great. Thanks for having me back on.
So heading into 2023, most economists were predicting a recession, and most strategists expected lackluster stock market returns. But it's been an amazing year for equity investors, particularly those who were overweight in technology giants. And this was despite rising rates and geopolitical turmoil. So looking back at 2023, why the economy and stocks surprised to the upside in your view?
I think it just comes down to the fact that the economy was quite resilient, with the resiliency being fueled by a durable consumer. So even though we had high interest rates, the consumer remained significantly strong, and they were supported by really strong labor trends. So if we were to look at just even the employment to population ratio, that ratio is above 80%, and that has been above 80% every single month this year. The last time you had an employment population ratio above 80% for every single month in a calendar year was 2001. So it was a very, very strong economic environment that defied the recessionary forecasts because the consumer remained quite strong. Labor was robust. If you look at the JOLTS report, they've obviously softened a bit. The job openings reports, they've softened to come down off of highs, but they're still above pre-pandemic levels. At the same time, you have inflation-adjusted disposable income, which is a really strong portion of what drives broad-based consumption. That's up 3.8% over the past year. You have nominal wages growing. You have real wages growing, and you have overall aggregate demand growing. So the consumer remained quite durable, and I think that proved to be quite resilient for the broader economy. We did not have the recession that a lot of economists forecasted. And it looks like, I think pretty much in the last 2 months, the market has coalesced around the idea that the Fed will be able to land this plane and have a soft landing and sort of navigate a tricky inflation growth dynamic. And the market sort of reacted favorably to that. And so I think, the whole idea is 2023 was resilient. And what we think is 2024, we're going to be testing that resiliency.
So let's talk a little bit more about 2024. So it appears that the Fed delivered an early Christmas present to markets yesterday. And for reference, we are recording this on December 14th. So the central bank is now forecasting at least 25 basis points cuts next year because inflation continues to cool. Fed fund futures are now forecasting about 150 basis points of rate cuts. So is the market getting ahead of itself? So let's talk a little bit about State Street's 2024 market outlook. What kind of U.S. economic growth and earnings growth you expect? And you mentioned that the market is expecting a soft landing. Can the Fed pull off a soft landing?
I mean, I think they can, and I do think they will. So our sort of broad-based view on economic growth is that we're likely to see, roughly around 1% GDP growth for 2024. That could perhaps surprise the upside, but basically don't expect the 3% that we saw, the last couple of years, or even on a long-term basis, right? So it's going to be softer than what we've historically witnessed. Same thing on a global scale. So global GDP growth is likely to go below long-term historical averages, roughly around 3%. And it's obviously going to be dragged lower by developed nations, but of course also emerging markets like China. And that's the big thing, is that the growth will be slowing, but it will not be negative, right? So this idea of a recessionary, again, another recessionary forecast, those continue to sort of come out. The idea here is that growth will still be positive. Recession will not come in 2024, but it will be slowing, and inflation will start to come down as the Fed, really engineers the soft landing and it keeps inflation somewhat under control. In our view, from a monetary policy perspective, when we look out at the horizon for Fed meetings, and your question of is the market getting ahead of itself? The market's going to try to anticipate Fed actions, and they might be overestimating the severity or the magnitude of the cuts, but they're not overestimating the likelihood. So we are likely to see rate cuts in 2024, likely starting in June, with another one in July. But for me, when I look at this, the meeting that everyone should really have circled on their books would be March. And the reason being is, if we're looking at the implied forward-looking estimates of rate policy, March is the first meeting in which there's even a probability, a very, very slim probability, I think it's in the single digits, of the Fed potentially cutting rates. So that's the first point. The second point is, it's basically 2 years to the day, or 2 years to the meeting, I should say, in which the Fed started their aggressive rate hike policy. And there's been research, there's multitudes of research, but Raphael Bostic, one of the Fed presidents, has put out research that says it takes 18 to 24 months for monetary policy to fully manifest itself into the broader economic trends. So 2 years, will be the March 2024. And then the third reason, I just think it's a calendar quirk, is that the last 4 years, March has been synonymous with a systemic risk event, whether it's start of the COVID-19 pandemic, regional banking crisis, and invasion of Ukraine by Russia. So, what would be this March's sort of hallmark event? And it could be where the Fed comes out in a very forceful manner using their forward guidance tool, which this Fed has done quite effective. We saw that at Jackson Hole this time. So they'll probably do it at that March meeting. And so that's the meeting that everyone should have on their calendars. And I think what we'll see is maybe market forecasts really reflect that over the next coming weeks.
So as you mentioned, we have seen this everything rally over the past few weeks since investors got the signal that the Fed will start cutting interest rates soon. And many investors now expect the stock market rally to continue in 2024. Is that too optimistic? What kind of stock market performance investors can expect from 2024?
Yeah, so it is interesting because the market has rallied so significantly just in the last couple of weeks. So if we look at it right now, you do see a pretty stretched type of marketplace. So when we look at things on a technical basis, RSI, your relative strength index, that is above 70. The number of stocks that are trading with an RSI over 70, there's about 30% of those. That's in the 95th percentile historically. So pretty kind of stretched risk market right now. I mean, even today, I know for those that probably listen a couple of days after, but today we're seeing a pretty big risk on rally. I mean, small caps are up quite a lot this afternoon, I should say. So if we're stretched now, will this type of stretched environment continue into 2024? I would say unlikely. And the reason being is that we're somewhat priced for perfection right now from a valuation perspective. So broad-based valuations are above their historical average. A lot of the gains this year have been driven by multiple expansion. So basically, a rising P, not so much the E portion is driving this. So I think next year what happens is the E portion of the price to earnings multiple will be the driver of broad-based returns. And if we look at forward-looking estimates on growth, we're in the US, which is the highest among all developed nations. or major regions, I should say, it's double digits. So I think if we were to say, what the forecast might be for returns in U.S. equities in 2024, likely double digits, supported by double-digit growth, but valuations are not likely to be additive to any of the returns. And that's why we do like sort of quality, stocks that are not stretched. So a little bit of quality, a little bit of value included in there. And the last thing I'll say about the return trajectory is it's not going to be linear. And I think we know that. Volatility right now is quite suppressed, quite low. The VIX has spent 80% of the days below his historical average. Usually you don't see that. And we do know that the economy will soften, right? So softer economic growth could, sort of weaken some of the fundamental foundations. But also there's going to be a confluence of geopolitical risk. We have two major wars going on in Europe right now, in the Middle East. And you also have a looming election cycle in the US, but also election risk is quite broad-based. I want to say something to the tune of 60% of the global market cap in the MSCI equity. The countries are having an election in 2024. So election risk is a risk, and that could create a less linear path to those 12% double-digit earnings growth forecasts for returns.
Great points. Now let's talk about positioning the portfolios for 2024. And you published an excellent note last week. It's available on ssga.com, and it has three main themes. So let's discuss each of them one by one. The first theme is targeting growth with quality U.S. equities. And several key points caught my attention. You expect U.S. outperformance over Europe and emerging markets, particularly China, to continue. And then you favor large caps, which you believe are better positioned than small caps for a slowing economy. And you mentioned quality. So you expect high quality companies to continue to shine. Now, quality factors has done very well this year. And even though the definition of this quality factor differs, when I look at the top holdings of popular high quality ETFs, Apple, Microsoft, Nvidia, Meta, these are the top holdings. These are among the top 10 holdings in all quality ETFs. So you expect these mega cap tech giants to continue to do well. Please talk about these points.
Yeah, so from an asset allocation perspective, right, we do like equities. We do like equities relative to bonds, I think, from some perspectives. But within equities, we favor U.S. equities more so than anything else. And the reason being is the growth there is quite supportive. So I think I just mentioned that earlier too. Out of all major developed regions, EFA, Europe, Japan, the growth forecasts for the U.S. are the highest, right? They're the only ones with double digits. The earnings sentiment also within the U.S., relative upgrades and downgrades, while that number is below 1 and it's below 1 across the globe, it hasn't been as revised lower. So we like the durability of the U.S. from a growth and sentiment perspective. There are some valuation challenges, but broadly, U.S. kind of seems to be one of the best houses on this block. And within the U.S., we favor quality because we do understand the economy will be continuing to interact within a slowing environment. And we saw quality do quite well this year. While we didn't have a recession, we did have a slowdown, right? The economic growth was slowing. So for those reasons, we continue to favor quality just broadly as a factor. At a more sector level, we do like tech in those tech leaders, but not in a market cap weighted fashion. We would much rather own it in an equally weighted paradigm because of just severe concentration risk so far. And, the Magnificent Seven, we would want to own those, but also some of the other portions of the tech market that have done well that are maybe a little bit further down the cap spectrum, not small caps or mid caps, but just not the Magnificent Seven. I think that, even in the movie, The Magnificent Seven, there was other other castmates that helped out in the end. So I think you need to sort of take the same view here, and we've seen that in some of our funds that are equally weighted tech. We do like that because AI is going to stick around for a while. It allows for more pricing power, higher margin. I mean, the whole idea behind AI is operational efficiencies. So if you are owning those tech leaders that are a driver of the democratization of AI and the ability to infuse into different parts of our economy, I think that's all the better. The other area within at a more sectoral level is insurance companies. Insurance companies, if we look at it, and this is where we get a little bit of the value side of it, insurance companies, they were sort of really beat up in 2022 and start of this year because of some of the concerns over commercial real estate as well as property and casualty insurance. We saw this a little bit in the regional banking crisis, a little bit of throwing the baby out with the bathwater, but we now are seeing earnings revisions moving up for insurance companies. So if we look at the sort of overall 2024 earnings projections, they're rising while the broader market is falling. So we do like that. They have shown some durability. They've shown some ability to navigate tricky situations. And, they do create somewhat of a value play is beyond the quality and earnings sentiment.
You also talk about dividend growth funds, and dividend growth ETFs have in fact not done very well this year because these ETFs have a lot of exposure to areas like industrials, like consumer staples that underperform the broader indexes. But over the longer term, very long term, dividend growth ETFs have done quite well because these are also high quality companies. So could you talk about dividend growth in this environment, why investors should look at those areas?
Yeah, so it's just a different way to obtain quality. So when we think about quality, there's also durability and balance sheet durability. If there are firms that have been able to deliver and raise their dividend for multiple years, in some of these funds, we screen for 20 consecutive years of dividend increases, but 20 is just the screen to get in. There are a couple of stocks in there that have raised their dividends for over 50 years. They've been able to weather different economic environments and cyclicality. So that's one way to think about quality. And when we do look at the underlying firms in there, they do have a lower standard deviation of earnings per share figures, as well as a lower debt to equity load this year. Even though, so again, like quality, the purest view of quality, a quality factor, right? That is owning stocks just based on ROE, debt to equity, and earnings variability, and other sort of profitability measures. The purest form has done quite well. The form that takes more of a that dividend growth aspect, at the end of the day, most of these exposures, like the ones that we have in our lineup, they weight based on yield. Because you're weighting based on yield and because you're selecting stocks with a higher yield than average, you have a value bias. And this has been nothing more than a massively quality growth led, high cash flow, high margin tech year in 2023. I mean, interestingly enough, there's only 3 sectors that are outperforming the broader market, and they're all up sizably. And it's tech, consumer discretionary, and communication services, and they're all up over 30% this year. And the market's up 20%. They're the reason, right? If you take them out, it's a much different return path this year. So we've been asked this question, like how our dividends, why didn't dividend stocks work this year, even though they do have a quality bias to them? It's because they have a quality bias, but they are a value play. And in a massively growth-led market, if you have even a bit of value, you're going to underperform, because beyond all the trends that we've seen this year, this has been a year because earnings per share growth, like I mentioned earlier, was flat this year, right? Everything was driven by multiple expansion. But the playbook was in a market devoid of growth, buy the area with the highest growth. And, that is that Magnificent Seven, the tech stocks, the communication services. So will that continue in 2024? Probably portions of it. And that's why we like some of the tech leaders, but we like to be more evenly weighted. But I still think you're going to have an emphasis on quality. And the way you can obtain quality is there's multiple ways.
Okay, great. So your second theme is emphasize stable income. And this talks about fixed income strategies. And it's been tough for bond investors. And even though bonds have rallied over the past 6 or 7 weeks with the decline in interest rates, many bond funds could still post their third consecutive year of losses. And many investors just piled into cash in 2023. Money market funds gathered over $1 trillion. Now, with rates peaking, maybe it is time to deploy that cash. But according to your note, it seems still too early to move into longer duration bonds. You favor shorter duration bonds, active management, and high quality intermediate investment grade bonds. Please talk about them.
Yeah, so there's $1 trillion that's gone into money market funds. We've seen ultra short duration government bond ETFs taking record flows. That's not likely to repeat itself in 2024, particularly because the Fed is going to cut rates. All of those assets will be staring down the barrel at reinvestment risk. So the yield that you're being quoted today on T-bills of 5.5%, 5.25%, that yield is going to be lower. So therefore, your realized return is likely to be lower over the next 12 months. So, if you're staring at a, pretty much a guaranteed lesser return than what you've realized over the past year, right? Your next 1 year return is most likely almost 100% guaranteed to be lower for the next 12 months than it was in the prior 12 months for T-bills. You're probably going to look for different opportunities. And we think taking a more total return mindset could be beneficial on even in that short end of the curve. So the long end is there's just too much volatility, I think, to withstand on a more tactical basis. Yes, there could be some duration-induced price depreciation if rates continue to fall, and we do think rates will fall a bit. I mean, I think they've probably gotten a little bit ahead of themselves over the past few weeks, and so I think we're probably not going to witness another. So in November, for instance, the 10-year fell 60 basis points. I don't think it's going to fall another 60 in December and into January. So I think there's going to be a little bit of sort of stasis in where the yield is now, which is roughly 4% and change. So I think I was talking to someone yesterday. We're probably more likely to see 4.25 on the 10-year than 3.75 first, right? So we'll probably retreat back up before we come back down. And that just reflects a lot of volatility in the long end of the curve. And I think you're not being compensated fairly enough to take on that volatility. That's why right now we do like, in terms of that compensation of volatility from a term structure perspective, we'd favor the 1 to 10 year space for investment grade corporate bonds. High quality corporate bonds, 1 to 10 year. You get a yield over 5.7%, but yet your duration is only 4 years. So you're taking on more duration, obviously, than cash. And so duration's a risk factor. And if rates do fall, you will have some price appreciation associated with it. But if rates rise, because interest rate volatility, if we look at an implied interest rate volatility, it's in the 90th percentile historically. So the range of outcomes are quite wide for what rates can do. And I think it's because we still have an evolving monetary policy that you maybe are getting more fair compensation by cutting off the tail of the long end of the curve and just owning the belly and the short end in the 1 to 10 year space. So we like 1 to 10 year corporate bonds. From that perspective, we do also like duration managed exposures that will target something between 1 and 3 years. So again, we're just trying to sort of get investors to think, how do you re-risk in fixed income out of that cash position, move slightly further up the curve, start laddering your bond exposures. We think active short duration managers are really strong in that capacity because they're going to take that total return mindset, be able to invest in different securitized credits that maybe have a long maturity like mortgages, but have a short duration because of the way payments are coming in. And you need to have that mortgage bias. I think mortgages are one of the areas that, from a sector perspective, could be a really strong source of returns because there's so much dislocation. If you look at the effective rate that most Americans are paying on mortgages, it's in the 3s, but the headline rate on new mortgages now is in the 7s. So there's a lot of dispersion. I think that dislocation can be beneficial for active managers. So the whole idea about this idea like stable income is that if you're buying 30-year 30-year treasuries, the stability, your day-to-day NAV stability that you are witnessing come pricing time is quite high, right? The realized volatility is quite high, and the income that you're getting is no more than the income that you could get with something in a less volatile return path in, let's say, the 1 to 10 year space. And that's where we think there's probably some more opportunities to have more stability alongside the income.
Now let's talk about the third theme. It is seek new opportunities supported by macro momentum, and it talks about areas like housing, like defense, like real estate, and it talks about some of the macro trends that could turn into headwinds for these areas. Please explain.
Yeah, so I think there's a couple. I would say there's probably two headline trends that I think we can anchor in on quite effectively. And the first is, what's going on the world stage from a geopolitical perspective. And the wars in Israel as well as Ukraine. We do have an election coming up. It is probably going to be a very contentious election. I think that's been kind of the status quo now for the last couple of days, or not days, last couple of election cycles. But the one area where I think most politicians can agree upon, and we see this already within the walls of Congress, but also on the campaign trail, is around defense spending. So I think there will be a political backdrop that supports a focus on defense. I mean, the Biden administration has proposed $106 billion supplemental aid to Ukraine. You've seen the Republicans come out. I mean, there's been some back and forth on it, like you'd see in any sort of legislative process. But there is more of a bipartisan agreement around defense spending. And I think we have seen this over the last few years where the defense budget continues to expand. In 2019, it was $687 billion. In 2023, spending was agreed for $817 billion. Bills are being put out now for almost $890 billion under national defense. And again, given what's going on the world stage, it's only likely to probably increase and be more important to ensure the funding of different military programs. And so far, we've seen, particularly if you have a motivated consumer like the U.S. Defense Department, and you're a defense contractor, that motivated consumer can be a benefit to your bottom line. Aerospace and defense firms have had their 12-month earnings forecast revised upward by 3% since the start of the most recent earnings season. And during Q3, those firms posted 57% earnings per share growth, with almost 80% of them beating estimates. And more importantly, because we saw some sluggish on the revenue side in the broader market, where revenues trailed earnings growth again, which means margins were likely the reason why we had good earnings in the broader market. There's been strong demand. Sales growth was 10% for these aerospace and defense firms, with almost 85% of the firms beating on estimates. So we like defense for those reasons. A political backdrop that will support more defense spending. At the same time, the other area that has some macro momentum to it is something I touched upon earlier around the consumer. The consumer is likely continuing to remain strong, and a strong consumer can likely continue to support a strong home and home building and home retail industry. I mean, supply is tight. It's definitely a seller's market right now. While existing home sales have fallen, new home sales are up. Also, if you see the remodeling market condition indicator, that's down a little bit off its recent highs, but still well above historical averages. In home builder stocks this year, they definitely flew in the face of all those critics that high rates would hurt housing. And all they have done is gone to post a 40% gain in 2023, which is well above the broader market. And what we see from our earnings perspective, those gains are supported by earnings too. More than 83% of the firms in our home building industry fund, they beat earnings in the most recent earnings season, outpacing by like 9%. And those are figures well better than the broader market. At the same time, their 2024 earnings forecasts have increased 4% over the last few months, while the broader market is down 60 basis points. And the last thing, I'd say there's probably two more things, is that even despite a 40% gain for home builders, if you look on a price to book basis, they traded a 20% discount to the broader market. That's compared to a 12% historical median. So there's still a value case in home builders because there are so many skeptics even heading into this year that they're still very underowned. And I think the last thing is that, if the Fed does cut rates, that's going to unlock so much affordability in housing. The mortgage costs will go down. It's a tight supply. All of a sudden, supply might open up, and then you have more buyers coming into the marketplace. And, you still have rising home prices. So I think home builders is going to be another area supported by macro momentum. And the macro momentum is from a sturdy consumer. And that sturdy consumer may be supported by additional Fed policies.
Excellent stuff, as always, Matt. We'll have to leave it there, but thank you so much for joining us today and for sharing your insights.
Thank you.
That was Matt Bartolini of State Street. Now let's talk about some ETFs that you can use to implement those ideas. For quality factor, State Street offers an excellent ETF. The ticker symbol is QUS. In fact, it has a multi-factor strategy that blends quality, value, and minimum volatility. For dividend growth, you could look at the Spider S&P Dividend ETF. The ticker symbol is SDY. This invests in companies that have consistently increased their dividends for at least 20 consecutive years. Another ETF, dividend growth ETF that I like is VIG by Vanguard. This is the most popular in this space, and this holds companies that have increased their dividends for at least 10 or more consecutive years. Now, for technology, he mentioned the importance of equal weighting. So the State Street ETF is Spider NYSE Technology ETF. The ticker symbol is XNTK. And this is a great ETF if you do not want too much concentration in the Max 7 stocks, because QQQ and its cheaper version QQQM, which are very popular with investors, they have about 50% exposure to Max 7 stocks. Now, for home builders, the State Street ETF is XHB. It is the Spider S&P Home Builders ETF. This is also equally weighted. And in addition to home builders, it has a lot of exposure to home furnishing and other home improvement companies. If you want to look at the market cap weighted ETF in this space, the ticker symbol is ITB, that is by iShares, but very top heavy with a lot of exposure to the giants in this space. For defense, you could look at the Spider S&P Aerospace and Defense ETF. The ticker symbol is XA. And the market cap weighted ETF is ITA for defense, and that is again by iShares and very top heavy with a lot of concentration in the giants which are in this space. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcasts. Also, make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.